Hey everyone, I'm Jeremy Szafron. This is Kitco News. Now, we've been talking about it all week. The U.S. jobs report is out, and job growth slowed again in August with just 142,000 jobs added, well below the 165,000 economists were expecting. And on top of that, revisions to the previous 2 months have left us with the weakest 3-month average for job gains since mid-2020. We've also seen a jump in underemployment rates, hitting 7.9%, which includes part-time workers who want full-time jobs and discouraged workers who have stopped looking altogether. And while the unemployment rate ticked down slightly to 4.2%, the broader picture of labor demand is showing cracks, especially as wage growth lags behind inflation. Markets are reacting. Talk of a 50 basis point cut from the Federal Reserve is gaining steam. But with inflation still cooling, the Fed's next move isn't clear as may seem. Now, global growth concerns are also there, especially from China and Europe, are adding even more uncertainty to this pile, and businesses are holding back on hiring and expansion ahead of the November election. Now, the question everyone's asking is the Fed moving fast enough to heat off deeper slowdown? Or are we already seeing the early warning signs of a recession? Now, to help us break down this, all of this today is somebody who doesn't sugarcoat it. We have David Rosenberg. He's the chief economist at Rosenberg Research, joining us. David's been ahead of the curve on these issues, no pun intended. Welcome back.
Well, thanks for the invite on another Non-Farm Friday.
Another Non-Farm Friday. I mean, we just talked about it. We just got into it. You've looked at the report. And to be frank, you've been saying this for a while. I mean, you've been calling it very accurately since I've had you on since October. But I guess, the question is how much of this slowdown is structural? And is there a deeper issue with the labor demand than the Fed and the markets aren't addressing here?
No, there's nothing structurally wrong with the labor market. Remember that it was running really hot with all the fiscal and monetary stimulus occurring alongside the reopening once COVID was mostly in the rearview mirror. The structural problems really were a couple of years ago when the government was paying people not to work. And we had this lingering fear of coming back to the workplace because of COVID. And we had all the bottlenecks from the constraints from the supply chain issues. So we had structural issues that aggravated the tightness in the labor market, caused wages to spiral up, created that period of inflation that thankfully ended in the summer of 2022. But what we have in our hands is just a classic lag response to what the Fed has done. The U.S. economy is inherently a credit-sensitive economy. Many segments of it, especially in the economic-sensitive areas, do respond to interest rates. But as the economists always say, the lags are long and variable. They're always variable, and the lags in terms of duration can often take many, many months, if not even a couple of years, as we saw back in 2006 and 2007. So this is really a function of the impact that interest rates have had. And it does have an impact on aggregate demand and then ultimately on employment. And that's what we're seeing right now. It's just the cycle at play. The markets move in cycles. The economy moves in cycles, interest rates move in cycles. You look over a century worth of data, there's just these sine waves, these centrifugal forces that move over time and overlap with each other. And so nothing here really surprises me too much. Am I surprised that it took so long for the cracks to emerge in the labor market? Yes, that's true. It took a longer time this go around because a lot of the impetus to growth came from the lingering stimulus of fiscal policy that right now is moving more towards neutral and not contributing to the economy. So the lags from what the Fed has done, all that damage is now hitting home. And, you look historically, and the last man standing is generally the labor market. But now it's not collapsing, as you said, but cracks are clearly emerging in the once hot labor market story.
Yeah. Jump into those cracks a little bit more because, manufacturing, retail sectors shedding jobs like crazy. And then healthcare and education barely had any. So, I mean, is the Fed ready for a long-term change in the composition of workforce? Like, how does this affect their response?
Well, it's almost like you're seeing it in the stock market too. Like you've had this rotation out of the growth stocks, and they move towards value, but the value they've been moving to were like like tobacco stocks, right? Staples and healthcare, utilities. So you're seeing that shift, reducing the beta in the portfolio and the cyclical exposure within the sector rotation that we're seeing in the stock market. And you're seeing a very similar sector rotation in the economic data. You don't typically find that in recessions or hard landings that things like education or healthcare typically go down. They don't really move with the economy. That's just basically, call it demographic driven. So not a big surprise there. Half the growth in what was really quite a tepid 142,000 increase, as you had mentioned, in non-farm payrolls, half of that came from two sectors, government and then education, health. When you're taking a look at the more cyclically sensitive sectors of the economy that will ultimately respond to the impact that higher interest rates have had on aggregate demand, seeing declines in manufacturing, seeing declines in the retail sector, seeing declines 3 months in a row in the retail sector. So what are retailers telling economists, or what are retailers telling market participants what their outlook is for the consumer spending? Outlook isn't exactly a pretty picture. And then we have stagnation in employment amongst the banks, transportation services, which really are a front window on what the economy is doing. And the same thing within the retail sales reports, which you could argue have been relatively buoyant. But you're seeing distinct shifts taking place, not just at the low end and middle end of the income cohorts, but also the higher end towards trading down, bargain hunting, becoming a lot more non-discretionary in their spending behavior. So, people look at headlines, like they'll look at the headline today, they'll say 142,000. I mean, never mind that half that number, came from the birth-death model, but they'll say it's not so bad, it's not contracting. But when you look beneath the veneer and you look at the economic sensitive areas, there's a clear shift taking place. And you're seeing that in the consumer spending space as well. When you start to see these shifts and patterns towards frugality, that is usually a leading indicator for what's going to come down the road in terms of the actual headline numbers. So you can look at the headline numbers, but they're coincident to lagging. What you want to do is find the nuggets within these reports that are giving you a window on the future. And you typically find that the shift in consumption patterns, as we're seeing right now, tend to lead the consumer recession. And you're seeing in the employment side, we got to take these numbers with a grain of salt. The one thing that wasn't mentioned was the 86,000 downward revision to the previous 2 months, which actually just makes your head spin. That what you see isn't what you get. So who knows? The 142,000 we got today, 2 months from now, we're going to find out it was more like 70,000. But be that as it may, the macro bulls will say, well, at least employment's not contracting. But when you look at the leading indicators within the report, just like the retail sales, you look at the leading indicators within the report itself. It is not painting a soft landing picture, one iota, notwithstanding the fact that remains. Now, the soft landing has been a call that's worked. I think that the expiry date is staring us in the face. And, I mentioned before about, we're talking about the economic data. And, we mentioned before about, the shift towards defensive sectors of the stock market that won't kill you in a recession because they're typically economic insensitive. But look what's happening with the small cap stocks. They're rolling over right now. I find this very fascinating. The small cap stocks, which, a month ago had a bit of an upward blip, have now rolled over. And the Russell 2000 is now down 15% from the cycle high. Of course, everybody focuses on the tech stocks and they focus on the S&P 500. But I think you have to take a very broad and eclectic view of the various major averages. And the small caps are the window on the domestic economy. And what you would ordinarily expect if we were heading into a soft landing is that as market rates come down, and market rates are coming down sharply in advance of the Fed, what should be happening if the soft landing narrative still has legs is a small cap stock should be rallying. But rates are coming down and the small cap stocks are rolling over. And that is a signal for all of us that the soft landing narrative is starting to wither.
Interesting. Okay. You were talking about those nuggets when you start to get into the data too that I found interesting is teenage unemployment is rising. I mean, it's jumped to 14.1%. And then of course we got this underemployment problem too, 7.9, the highest since October 2021. What does this tell you about the future as an economist? When you look at data like that, where do you guesstimate we're going to land?
Well, I mean, firstly, you had a bit of a divergence between the classic U3, which went from 4.3 to 4.2, and the U6, which went to 7.9 from 7.8, as you correctly posited. And the U6 is very useful because it includes all forms of unemployment. So the U3, the classic unemployment rate that we all look at, has a very confined definition of what the labor market is, because to be counted as unemployed in U3, you have to be actively looking for work. But what the U6 includes are discouraged workers and marginally attached people to the workforce. In other words, I might not be actively looking for work, but if I was offered a job right away, I would take it. Well, the U6 includes that as a form of idle labor resources, and that's why I think it's actually the better measure. I look at the unemployment rate more as a sign of labor market slack. Like Jay Powell had said very clearly, he's looking at, job vacancies to unemployment. He's looking at the various unemployment rates. The U6 is the broadest. And as it goes up, and as you said, it's at the highest level since October 2021, over time, remember there's lags, that's going to put downward pressure on wage rates, which is why I wasn't too fussed with the 0.4% reading on average hourly earnings. I think that's looking at the situation in the rearview mirror. Rising slack in the labor market, which is what the U6 is telling you, and the U3 is as well if you're looking at it on a year-over-year basis. But the U6 is a very important indicator in terms of the fact that it contains everything in the jobs market that pertains to slack. And that slack with a lag is going to trigger wage compression, which is disinflationary. So do I look at that as a recession indicator? Not so much. I know people look at the unemployment rate and the SAM rule, so on and so forth. I think the most important statistic that came out today was from the household survey. And what it showed was that household employment, the companion report to non-farm payrolls, and full-time employment, both of them are running negative now year over year. They're running negative year over year. And that is a 100% ironclad recession indicator. So the unemployment rate tells me something about, should I be worried about inflation? The answer is no. The fact that the year-over-year trend in overall household employment and full-time jobs now running negative year-over-year has only in the past 6 decades happened in the context of a hard landing, not a soft landing.
Right. Yeah, well, that makes a lot of sense. Okay, Federal Reserve Governor Christopher Waller, I think, was in Indiana today, and there's a couple of quotes that he was saying. One, the balance of risk has shifted towards the employment side of our dual mandate. Policy needs to adjust accordingly. And then the second that I found interesting was the current batch of data no longer requires patience, it requires action. So, I mean, David, obviously there's talk of a 50 basis point cut on the table. What inflation moderating, markets adjusting, could cutting that aggressively now introduce new risks?
Well, there's this sense in the marketplace that, God forbid, if the Fed cuts 50 basis points at the September 18th meeting, that the equity investors will freak out because it means that the Fed sees something that nobody else sees, and that they think that a recession is imminent. I don't necessarily buy that view. I think that the Fed is just simply significantly behind the curve. They have not, like, if you're taking a look, for example, at where the 2-year Fed funds spread is, they're massively behind the curve. When you're taking a look at what the futures market is pricing in, you could argue the Fed is probably 150 basis points behind the curve. And we know from the last set of FOMC minutes that there was support, although it didn't happen. There was support for a rate cut at the last meeting, and they decided to stand pat. So going 50 September 18th is just a recognition that we should have gone at the last meeting. We should have gone 25. We're going to ordinarily would have gone another 25. And so therefore we go 50. I'd rather have the Fed go 50, especially if you're in the soft landing camp and you want the Fed to get ahead of this thing. You'd rather have them go 50 September 18th and wait for the whites of the eyes of the recession to start and then start cutting 50, because that's when panic sets in. The Fed can go 50 and simply say, look, we all know that there was a groundswell of support for 25 at the last meeting. We didn't do it, so we're going 50 right now. Look, the Bank of Canada has already gone 75 basis points the past 3 meetings. They've gone 25 per meeting. If they had waited till now to cut 75 basis points, that would have freaked a lot of people out. But at least they started earlier than the Fed, a lot earlier. So I think the Fed has just waited too long. And, Austin Goolsbee was talking today about the fact that rates, whether you have a recession forecast or a non-recession forecast, benchmarked against where the economy is right now and benchmarked against where inflationary pressures, not inflation, but the pressures on inflation are right now, it's time to start cutting rates. Now, either you pay attention to the markets or you don't. The markets are telling the Fed that they are way behind the curve. So I don't think that they're going to get ahead of the curve going 25 basis points. I think they should go 50. But, I could see some of these, former hawks on the Fed digging in their heels because of the wage number, which doesn't concern me. But, I find that I'll tell you the truth, I find that the current Federal Reserve, I've been doing this for 40 years, on the economy, it's the weakest Fed that I've ever seen. I think that they only really look at the headlines and they don't dig beneath the veneer into the details. If you dig into the details of this report, you'd be going 50 basis points September 18th. And then to prevent a panic or the narrative that, the Fed sees something we don't see, I think you can easily explain that, we just view ourselves behind the curve and we are going to move swiftly to get back ahead of the curve. And I don't think that really is going to save us from a recession. However, I think it'll help calm investor nerves, the way that they communicate it.
So talk to me. I mean, you brought up Canada there. Obviously, we're seeing some cracks in different economies too. And when you think about the Fed in the U.S., I mean, China, Europe is weakening. How vulnerable is the U.S. to external shocks? I mean, do you think that the Fed has enough room to maneuver if the global slowdown turns into a deeper recession abroad?
Well, the Fed has a ton of room just because the starting point of the funds rate, call it 5 3/8, is so high in nominal terms and benchmarked against where inflation expectations. They have a ton of room. And will it be enough at this point to prevent the recession that, of course, everybody now believes will never happen? This reminds me so much of when I was at Merrill. The Fed hikes rates from 1%, to 5.25%, almost a similar cycle back from 2004 to 2006. And then nothing happens. We're trudging along, and I think Bernanke stopped raising rates in the springtime of 2006, and the recession doesn't happen immediately. And then the next thing 18 months later, the recession actually starts, and the Fed is too late. And I think that had happened this time around as well. The Fed was too late to fight inflation, and they were too late to fight what's happening in the economy right now, which you could argue is not in a recessionary state, but the recessionary pressures are building. And the Fed is a risk manager and should at all times respond to risks and probabilities, as they shift. And that's one of the reasons we get business cycles, right? It's, AI is not running monetary policy. Robots are not running monetary policy. These are very smart human beings, but they're prone to make mistakes. And that's why we get these cycles. And so I think that the sooner that they start to cut rates, and the more significantly that they cut rates, the sooner we'll get to the economic recovery. There's nothing they could do right now. We are still responding to the lags of the damage the Fed had done. Much like that previous cycle, when the Fed was cutting in the summer, fall of 2007 and into 2008, cutting hard. When the Fed started cutting rates in the summer of 2007, everybody was just rejoicing that we avoided the recession. And nobody realized that the recession started in December of 2007, right? That was 3 months before Bear Stearns. That was like 9 months before Lehman. And actually, it was the recessions that caused the financial crises. The financial crises didn't create the recessions. The recession already started at the hands of the Fed in December of 2007. And believe it or not, everybody had visions of soft landing into the summer of 2008. And so we're just, again, replaying history. So I think the more the Fed cuts rates, and let's face it, the front end of the curve is screaming. The more they cut rates, then the sooner we will get to the recovery in 2026. That's how I look at the situation.
Okay, so 2025 will be a little bit of some growing pains. And I guess that makes me question, this whole election time in November, because we've been seeing that businesses are pulling back on hiring and investment just prior to the election. So if political uncertainty is holding businesses back, how much will rate cuts actually help? Are we looking at a scenario where the Fed could lower rate cuts, but businesses will remain on the sidelines until after the election regardless?
Well, firstly, look, it wouldn't be the first time that the Fed cut rates this close to an election, although it hardly ever happens. But it's not a precedent setter because Volcker, of all people, cut rates in September of 1984. And even though that wasn't a recessionary backdrop, we had a situation where through the balance of the year, bond returns actually smoked what the stock market accomplished. To keep that in the back of your mind. And that wasn't in the context of a hard landing. So, I mean, the point is that, yeah, there is uncertainty. I don't know why that's something brand spanking new for the markets, unless everybody took the summer off. And my sense is that what's really important to me is the down ballot vote and how the configuration of the House and the Senate go. I have a strong suspicion that we're going to have split government. And that means a lot of what Trump and Harris would want to do on the legislative side is going to be pretty difficult. What hangs in the balance, of course, are the components of the 2017 Trump tax cuts that sunset next year. And the extent to which a new Congress would actually allow all of it or part of it to actually sunset, that could have some significant fiscal drag on the economy. 100% true. But the Fed will respond to that. And when you're taking a look at fiscal policy versus monetary policy, in terms of the impact on the economy, and I would say on the impact on the markets, monetary policy is infinitely more powerful. There is nothing more important for a credit-driven economy than interest rates, far more important than fiscal policy. And of course, when you're talking about the stock market, which is a long-duration animal, as interest rates go down, then the discount rate goes down and the present value of those future cash flow streams become more valuable. Of course, in a recession, that earnings base is coming down, and that's why in a recession, the stock market goes down, even though interest rates come down, because you're discounting off a lower earnings base. But it's like every other cycle, things will bottom out. As I said, the quicker the Fed moves, the quicker the looming, if not current, bear market in equities will end. And the recession that I think is staring us in the face will end. And I've been saying all along, and I think on your show as well, that the business cycle has never been repealed. This view that we, after the most acute Fed tightening cycle since the early 80s under Volcker, that we somehow got a get out of jail free card because of the CHIPS Act and the fiscal side, which only basically for a period of time acted as an antidote to what the Fed has done. Well, that's on the rearview mirror. So the lags are the lags. They're next to impossible to time. But I mean, you don't have to be a rocket scientist to look within the data to see what's really happening. And, GDP is not Bitcoin, and GDP is not the stock market. GDP doesn't move like a yo-yo. GDP moves glacially, and you don't automatically plunge from expansion into contraction. You don't it's not like a diving board. The economy operates differently. It's almost like the boiled frog analogy. And so the economy is not the boiled frog that you throw into the boiled water and it jumps out. It's the frog that's in the water that is slowly starting to boil and bubble. And that's how the economy operates. The stock market might go down 30% in a recession bear market, but in a recession, you can have GDP go down, 1 to 1.5%. And that would be classified as a pretty average sized recession. And so the bottom line here is that there's nothing the Fed can do right now to prevent what's going to happen in the next year. The Fed should be moving rates down now for a down payment on the cyclical recovery that should take place in 2026, with or without the need for any fiscal stimulus.
Mm-hmm. Yeah, amen. Well, that's what we're all hoping for. And as you mentioned, of course, we have that September 18th meeting that we're all looking towards. What is it, 25, 50? Of course, we'll get you on just after that. David Rosenberg, Chief Economist at Rosenberg Research, joining us today. Thanks for this, man. You've been spot on, so I appreciate your intel on this. Hopefully we get the next data and we can unpack it together.
Excellent. Would love to.
Thanks, David. Appreciate it. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for watching. Don't forget to hit that notification button and stay up to date with all the latest analysis. We'll see you next time.